Crypto mining has long faced criticism for its environmental impact, but one US-based company is challenging that narrative head-on: TeraWulf. While many miners still depend on fossil fuels, TeraWulf, trading under the ticker WULF, is quietly building a zero-carbon Bitcoin mining empire powered by nuclear and hydropower. In this video, we're diving deep into why WULF stands out in a crowded sector. From its clean energy strategy and institutional partnerships to its expanding hash rate and cost efficiency, TeraWulf could be one of the most forward-thinking plays in the crypto space. So is this the Tesla of Bitcoin mining? Let's break it down. TeraWulf is one of the only vertically integrated, ESG-first crypto mining companies in the US. Unlike peers who rent infrastructure or rely on volatile energy markets, WULF owns and operates its mining facilities and sources nearly 100% of its energy from renewable and nuclear sources. Its mission is straightforward: sustainable, scalable Bitcoin mining. By aligning operations with zero-carbon energy from day one, the company has carved out a clear identity, one that resonates with both environmentally conscious investors and regulators tightening the screws on carbon-heavy operations. TeraWulf's model is also built to be cost-resilient. Instead of buying electricity from volatile wholesale markets, the company secures long-term, fixed-rate deals. This gives it better visibility into operational costs and protects margins even when market conditions shift. TeraWulf's two flagship facilities showcase its clean energy model. Once a coal site, this hydro-powered facility now runs 160 megawatt of mining capacity and has room to grow to 500 megawatt. It's supported by a 10-year contract with the New York Power Authority, securing 90 megawatt of hydropower. These clean energy sources not only improve WULF's environmental profile, but also reduce the regulatory risks often associated with high-emissions mining operations. That makes WULF more attractive to institutional investors, ESG fund managers, and even potential government partners. Low-cost, zero-carbon power enables TeraWulf to maintain strong mining margins, even during bear markets. The Lake Mariner site operates at $0.045 per kilowatt-hour, while Nautilus's nuclear rate is one of the lowest in the industry. Beyond profits, these clean operations position WULF as a regulatory darling in an increasingly ESG-focused world. The energy strategy also gives TeraWulf operational flexibility. In times of high electricity demand, it can curtail mining activity to sell power back to the grid, turning a potential cost into a revenue opportunity. TeraWulf isn't just about clean energy, it's scaling fast. As of December 2024, the company had 195 megawatt online, generating 9.7 EH/s in hash power. In early 2025, a new mining building at Lake Mariner pushed capacity to 245 megawatts and hash rate to 12.2 EH/s, a 52.5% year-over-year jump. But that's just the beginning. By the end of 2025, WULF plans to deploy 72.5 megawatts of high-performance computing hosting for its Core 42 tenant. Long-term, management is targeting 250 megawatts of HPC capacity by 2026 and over 400 megawatts of total operational infrastructure, including both Bitcoin mining and AI-focused data services. This dual strategy, supporting both blockchain and AI, is setting the stage for long-term relevance and diversification. It allows WULF to tap into two of the fastest-growing segments of the digital economy, positioning it as a hybrid infrastructure company, not just a crypto miner. TeraWulf's rise has been fueled by smart alliances. Its early joint venture with Talon Energy helped pioneer behind-the-meter nuclear mining. Although WULF sold its Nautilus stake in 2024, the project remains a blueprint for low-cost, clean crypto mining. Government support is another strength. WULF holds a formal 10-year hydroelectric contract with the New York Power Authority and participates in state grid balancing programs, aligning its business with broader public energy goals. These relationships, combined with transparent carbon disclosures and ESG reporting, are attracting institutional interest. About 62% of WULF shares are institutionally held, with analysts from Rosenblatt and others issuing bullish targets between $6 and $7.1. When large financial institutions begin to lean into crypto, they often prefer companies with regulatory alignment and transparent governance. TeraWulf fits that mold perfectly. Despite the recent Bitcoin halving and rising energy costs, TeraWulf remains in a strong financial position. In the first quarter 2025, revenue dipped to $34.4 million from $42.4 million YoY due to crypto market headwinds and increased network difficulty. However, the company expanded its capacity significantly, offsetting some margin pressure. COGS rose 70% to $24.6 million, largely driven by winter energy price spikes. Still, with $219.6 million in cash and BTC holdings and only $500 million in low-interest convertible debt, WULF has ample runway. It also repurchased $33 million in shares year-to-date, signaling confidence from the inside. Debt maturity isn't until 2030, and interest expense has dropped significantly YoY, giving TeraWulf flexibility to pursue additional CapEx, partnerships, or strategic acquisitions. ESG isn't just a buzzword for TeraWulf, it's a business strategy. In April 2024, the company published its first corporate social responsibility report, reinforcing its commitment to zero-carbon mining. Both facilities, Lake Mariner and Nautilus, run on 95 to 100% clean energy. With a dedicated sustainability committee and transparent reporting, WULF is positioning itself for inclusion in ESG-themed ETFs and portfolios. As governments crack down on crypto's energy consumption, WULF's preemptive compliance could give it first-mover advantage. Its long-term clean energy contracts and regulatory engagement make it a model operation for tomorrow's standards. Investors seeking climate-conscious crypto exposure have few credible options. TeraWulf may be the one that stands tall. Of course, this isn't a risk-free play. WULF's dependence on Bitcoin prices, energy markets, and flawless execution of its HPC expansion adds volatility. In April, WULF shares fell over 15% due to crypto market weakness. Power costs also spiked in the first quarter, showing how even low-cost models can be tested by extreme weather. Delays in Core 42's rollout or future supply chain hiccups could weigh on momentum. The success of TeraWulf's hybrid strategy, serving both crypto and HPC clients, will depend on its ability to meet ambitious build-out timelines, stay cost-efficient, and keep attracting demand on both sides of the business. So, while the upside is compelling, this is a stock for investors with a long-term horizon and high risk tolerance. TeraWulf offers a rare combination of sustainability, cost efficiency, and growth. Its average power cost is among the lowest in the industry. Its ESG-first business model is aligned with the next generation of investors and regulators, and its expansion into HPC adds a second growth engine beyond crypto. The $425 million raised via convertible notes at just 2.75% interest, that's a strong vote of confidence from institutional backers. If crypto infrastructure is going green and regulators are demanding cleaner operations, TeraWulf might not just be following the trend. It could be defining it. TeraWulf isn't your typical crypto miner. It's a clean energy disruptor with a clear mission, scalable operations, strong partnerships, and a growing presence in both blockchain and high-performance computing. The future of crypto will likely belong to companies that combine profitability with sustainability. And right now, TeraWulf is one of the few doing both. The question is no longer whether crypto should go green, it's who's leading that movement. Drop your thoughts in the comments, hit that like button if you found this valuable, and don't forget to subscribe to Stocks Telegraph and turn on notifications for more deep dive stock insights.